Hey guys, welcome back to the show. As always, I'm your host, Akil Stokes. Today, we're going to talk about correlation risk and how to set up your portfolio in a way that is safe, but also doesn't put you at risk of missing opportunities, right? Random acts equal random results, and that's the exact opposite of what we want to achieve as traders. Now, before we hop in, do me a favor. If you haven't done so already, make sure you leave the podcast a rating or a review. It takes about a minute of your time, but it is very helpful in growing the show, reaching new traders, and getting more awesome topics to discuss. So while you're listening, perhaps load up that thing that allows you to rate and review, type something nice, 5 stars if you think I'm worth it, and leave it. And that way, you could be a supportive member of the Trading Coach podcast. All right, let's hop in. Let's go back to the question. I am shorting Euro Yen right now, the same situation there, but there's a valid cipher. I didn't like this bat. So what didn't you? So first red flag. Who can identify the first red flag? And of course, we're going to need some context behind it. But the first red flag is I didn't like it. Okay, now. Remember, we're not trading what we like, right? We're trading what we see. So let me ask you, what didn't you like about the bat? Now, if you didn't like it from an analysis perspective, that's okay. If you're like, I didn't like the X to A or the B to C or whatever it was, that's fine. But if you didn't like it because of correlation risk, that's a problem. Because let me ask you this, right? So I get the idea or the situation that, hey, correlation risk, I don't want to be overexposed. Is that the fear? If I'm shorting Euro Yen and shorting Canada Yen, too much exposure to Yen shorts? Is that the idea? Or the fear? Yep. So let me ask you this. Why have both pairs in your portfolio? If you don't want to have exposure to both, why put yourself in a situation where you can have exposure to both? Now, there's different ways to deal with correlation risk, but my mindset has always been this, right? So I trade every advanced pattern. Okay, it's 20 pairs. So yes, that's an even bigger problem, right? Because you're going to have even more correlation risk. Now, one. And again, everyone's different. I think trading every advanced pattern on all 28 pairs. Have you tested advanced pattern? I'm assuming you've tested them on all 28 pairs, correct? And I'm assuming that they're profitable on all 28 pairs. Now, what is your rule on correlation risk? Is it that you cannot have two similar positions in the same currency at once? Entering at market doesn't make any difference. Yep. So you choose which to trade. So this is a massive problem. This is a massive problem because our edge, and I've been a pattern trader for I don't know how many years now, going almost 15 years, I would say. The edge in any system, any strategy, is trading it consistently. Because let me ask you guys this is for the whole room. As traders, do we ever know if a trade is going to win or lose? Do we ever know? We never know if a trade is going to win or lose, right? I can have a sample size of 100 trades. And out of those 100 trades, I don't know if trade 1 is going to be a winner, if trade 5 is going to be a winner, if 16 is going to be a winner. I don't know if I'm going to win 10 in a row to start the year. I don't know if I'm going to lose 10 in a row to start the year, right? We have no clue. And because we have no clue, our job is simple. To execute our edge, we want to take every single trade that is valid. Because although we don't know on an individual basis if a trade is going to win or lose, right? Short term, long term, we know that if we consistently execute the plan, we're going to be in the positive because at the end of the day, those numbers should be positive based on our testing. We just don't know when or how they're going to come. So the problem with picking and choosing is we're trying to pick winners and we're trying to avoid losers, but we don't actually know when a winner is coming. We don't actually know when a loser is coming. So we're just taking random acts And when we take random acts, are we still executing an edge? No, right? We're just being random. There's no consistency to it, right? We can go back to the coin flip example, right? Coin flip, you have a 50-50 chance of winning or losing, right? So if we were to flip a coin 100 times, what do you think would give you the better result? Picking heads all 100 times, or trying to pick or switching back and forth between heads and tails and heads and tails, right? So it's the same thing with patterns. You can't pick and choose, or trades in general. You can't pick and choose. You can't pick and choose. You have to trade every valid one, and this goes for any strategy. You got to trade it. You got to trade every valid one. If not, you're just doing random stuff in the market, and you're gonna get random results. If there are similar pairs on all patterns, I pick one. See, no, I think that's a bad idea too. It's still random. It's still random, right? Because you're looking at Canada yen, Aussie yen, Swiss yen, dollar yen, euro yen, pound yen, and they may all be giving you the same pattern, especially Swiss, Aussie, Canada, New Zealand yen. They tend to move similarly. So you've got 4 pairs. Let's say you have 4 pairs that are giving you the same pattern. You're picking one of them. How do you know you're picking the winner? What if you pick Canada yen and New Zealand yen wins? We're closing our eyes and we're throwing darts, hoping that we pick the winner. That's a random act. That is hopium. My advice would be this: if you know you have a grouping of pairs that's going to give you a similar setup, in order to protect yourself and not overexpose yourself to the market, because that's something that you don't want to do. You don't want to expose yourself to the market. You don't want to expose yourself anywhere. That's bad. It's illegal in most states. I don't know in the UK how you guys get down, but in America, it's illegal. You can't expose yourself. It's frowned upon. Again, I only have experience from here in America. I know the UK is a little bit different. You guys play by different rules. But if you want to control your exposure to the market, I would say this: just pick one of those pairs to have in your portfolio. You know you're only trading one anyway. You know that your rules say I can only pick one of them and I have to avoid the rest. Pick one. Pick the best performing one, or the one that doesn't correlate with something else, and leave the other 4 out of your portfolio. Now you don't have the dilemma of which one am I going to pick, which one am I not going to pick. You're not going to have that dilemma. You're only going to have one, and then you can consistently trade that one. And then you're no longer trying to pick winners. You're no longer trying to avoid losers. You're actually executing your edge the way that it's supposed to be executed, by consistently doing the thing that you're supposed to do, right? Because think about it, just like in backtesting. In backtesting, and I don't know if you did this or not, but in backtesting, we're probably not taking a trade on backtesting and then going back and then looking at another pair and being like, I wouldn't have taken that because I'm already another one. No, we're testing it through and through consistently. So our results are based off of that consistent action of taking every single trade that meets our rules. The results in backtesting aren't based off of, I would have taken this one this time, but that one not that time, and that one not that time. And our job as traders is we want to mimic our backtesting as much as possible, right? We're going to make mistakes. As you just saw, I missed the trade. I'm very mad about it. But that's human nature. That's going to be only a small percentage of the time, hopefully. So that would be my advice. I understand correlation risk. Trust me. You guys know my story of 30,000 down the drain, not paying attention to correlation risk, and then 60,000 missed, not paying attention to correlation risk. Yes, real stories. Still sad. Ashamed of it for a long time. But now I'm comfortable sharing it, because I believe that we should put ourselves out there and embrace our flaws. But there's a wrong and right way to do it, in my opinion. And again, I try not to tell anyone how to trade despite being a trading coach, right? I just try to put the information out there, because ultimately you guys have to decide it on your own. But my advice, and I think if you ask a lot of traders on the platform, random acts equal random results. And random results leave you in that Mark Douglas boomer buster phase, right? Remember, you have the traders at the bottom that just are bad. They fail out right away. You got the boomer busters in the middle. you have the successful traders at the top, and then you have like that very top part of like the super traders. Like that 1% is like super traders. And then it's the, what is it, like 10 to 20% of like 10% of like good traders. And then it's like what? 20 to 40, 30 to 40, somewhere in the middle of like boomer busters, which is where most people are at. And then like the other, whatever's left over after that, like 40 to 30 of just bad traders. So that would be my advice. So if you're looking to join any of these live sessions or be a part of the Tier 1 trading community and learn how to trade with awesome mentorship, awesome coaching, awesome supportive resources, and training courses, a lot more as well, make sure you head over to www.tier1trading.com. I recommend starting with the 14-day risk-free trial membership. That way you can get on the platform, talk to our other members, get a little sample of the course material, and see if we're the right fit trading-wise and philosophy-wise before you fully commit. www.tier1trading.com. I'll see you there, and I'll also see you on the next episode of the Trading Coach Podcast. Adios.